what we wanted to talk about in the second session is understanding credit. And again, I'm the Chief Lending Officer at Penn Air, and so get to lend all the time. As Stu said, consumer loans, which is auto, credit cards, that type of thing, and then business accounts. We loan to businesses, obviously, and we also do mortgages and home equity loans. And so we run the whole gamut. So I always like to start these sessions with a little unusual slide here, and I've got an open-ended question for you. So what do we got here? Snowflakes. And can anybody tell me what's a little unique about a snowflake? Right, exactly. And I always like it when somebody answers that question right, because that helps me a little bit, because your credit file is the same way, okay? The choice that you may make in applying for a piece of credit is different from the gentleman next to you. You may apply for an auto loan, he may apply for a credit card. You may choose to pay for your bills in 1 month, he may not choose to pay for a bill each month. And so there's literally millions and millions of variations of what can happen to your credit report. So just like the snowflakes that are up on the screen, no two credit reports are the same. Now they may have the same score, but they don't have the same makeup on there. So again, I like to start with that. Okay, so what's in a credit score? One of the things that I thought I'd mention here too is USA Today had an article on September 27th that was written, and I kind of like the title of it. It said Americans are not financially dumb, they just misbehave. And that's really the case here. And so what I'm going to try to teach you in the time that we have is really some common themes about how not to misbehave with your credit, okay? One of the things that, just as a point of reference and an analogy, if you go to McDonald's and have a Big Mac super meal and decide to get apple pies and everything, you probably got, what, 2,000 calories down there. But that special sauce was sure good. It tasted great. Those fries were super. The Coke tasted really, really good. So what have you all of a sudden done? You've probably consumed 2,000 calories and about 100 grams of fat. So, one of the differences between that and credit is, so what do? You've got food misbehavior. So if we go back to the reference of the USA Today article about misbehavior, you have food misbehavior. So what do? You probably go to the treadmill, do 500 sit-ups, you run like a wild person, out on the loop, and you do what you got to do to take care of that. But you probably regret it for 8 hours, right? Okay. So what do you think happens if you misbehave with your credit? It's a lot longer period. And so again, that's just an analogy. Food misbehavior over time probably is a bad thing for you, but credit misbehavior is probably a lot worse thing for you. One of the things that we'll talk about is, what credit scores are. They're a measure of your credit risk to potential lenders. And so, again, Penn Air is a lender, and we lend to people all the time. And so we certainly look at the credit score as a huge indication of that. That's one of the only things that we have as an indicator of how you pay. The credit score is also a record of how you pay. It's almost like a report card, if you think of it that way, of how you pay. And so that's really what's in a credit score. Now, so what's your credit score mean? Unlike golf, the high score is what wins, and the low score is what loses. So the range is actually, I've got 559 up on the screen for you, 500 to 559 as one of the lowest on there. Now, we could have kept on going. That score actually goes down as low as 300, and I have seen 300 credit bureau scores. There are ones with double repossessions, a foreclosure, a bankruptcy, some amazing things that happen to people over time, and bad things do happen to good people. But sometimes, when you're down in that 300 range, you're going to have a tough time building it up. So 850 is the highest score on there, and what that means is excellent. Okay, so think of the high score as low risk, and the low score as high risk. Okay, and this has everything to do with what you're going to be charged by any lender, whether it's Pen Air or any bank or any financial institution. Your credit score is going to dictate what you are charged in interest rate. We call it rate to risk. Okay, and so you see the scores up there. Any guesses on what in 2015 what the average credit score is across the United States? Okay. Any other? Not a bad guess. It's actually 695. And I think the lowest that it went at the peak of the recession in 2008, 2009 was actually 675. Now, in Florida, in what we call the Sand States, Florida and Alabama, actually the credit scores are some of the lowest in the country. They're in the lowest 10 states. And so the average here in Florida is 678. And the average in Alabama is actually 676. And so you can tell it's about 20 below the average score for the United States. But on average, that's not bad. It's basically in that average to very good level across the nation, which is pretty good. And I think that says something to the education. So, and that's what we're trying to do is talk about education here. So what's in a credit report? And really what it is, as I mentioned, it's a report card. It's identifying information with employers, payment history, bankruptcies, judgments, inquiries. I can look at a credit report and I can tell a lot about you because I have that information, and I need that information to make credit decisions. And any lender that's looking at you needs that to make lending decisions. How long does the information stay on it? So the great news is, if you pay your bills on time, it stays on there forever. Now I'm only 33 years old. I'm a little younger than John. So I've had a credit report for about 33 years, 35 years. And the good news is again, every bit of credit that I develop along the way, that's all in there. And so a long list of everything that's paid as agreed. Now, the bad thing is if you have negative information, it doesn't stay on there forever. Not even bankruptcy stay on there forever, but it stays on there for at least 7 years. And so if you go over 30 days past due on a credit card or on an auto payment or something like that, no, they may not take they may not close your line of credit on the credit card, and they may not take your automobile, but what it will do is affect that credit score over time. And so that's the negative information. Now, bankruptcy, I don't call it the kiss of death, but 7 to 10 years is a long time. It's in the credit world, it's close to doing a lot of damage, especially now if at your ages you're trying to develop credit, and at 30 or 35 you want to buy a house or get that car and do that type of thing at the time that you most need it, and you file a bankruptcy. That's going to live with you for 7 to 10 years. Doesn't mean that you can't overcome it. It's just there's an aggressive way to rebuild it. Yes, sir.
What determines the space between 7 and 10 years with bankruptcy? What determines?
Generally the type of bankruptcy, Chapter 7, Chapter 11, Chapter 13. And so that's a great question. Hopefully everybody heard that. The length of the bankruptcy is generally dependent on what type of bankruptcy they had. Now, some people also, they kind of push it out and it's dismissed and it's deferred and everything. That can make a difference as well. So sometimes that's the length as well. So, as Stu mentioned, who wants to see this? Well, a lot of people want to see this. Lenders, landlords, whether you know it or not, when you're getting insurance on your automobile, one of the things they're pulling is your credit report because they want to see your credit score, because it's an indication of how responsible or irresponsible you are with your bills, okay? And a lot of people don't know that, but insurance agents actually look at that, okay? And as Stu mentioned, potential employers certainly look at that. We deal with with giving people financial solutions every day. And if we don't know how to handle our own bills, we wouldn't be very responsible at people to be talking to you about your finances. And so, again, potential employers look at that. And it's not just banks and financial institutions that do that either. It's a lot of folks that want to see that from an employer standpoint. Okay, the 4 C's of credit worthiness. So character. I like to call this a person's willingness to pay their credit. Okay, and the 4 C's of credit worthiness. Sometimes you'll hear 4 or 5 different C's of credit, but these are the basics. Okay, and character again is that willingness to pay, and the difference between the willingness to pay is again, if you don't pay your bills, I can tell right away that you don't necessarily have a willingness to pay. So character is an important thing. Capital, you'll see up there, and that's what we would use for down payments or closing costs. So that's what's in your savings account, what's in your checking account, to John's point, what's in your IRA, what's in your 401k. If you're applying for a mortgage, you have to state every one of your assets and also the value of that, okay? Because they want to know how much ability that you have to do that. So from a capital perspective, you've got to have those down payments and closing costs. Now, capacity means it's to repay the debt, and I call this really the ability to repay debt, okay? And the difference between that and the character, so you have willingness and character, right? And in capacity, what you have is willingness. You don't have willingness to pay your credit if you don't have the means to do it. And so one of the things on capacity that we look at is your paycheck. So we're looking at what your gross monthly income is, and we're looking at versus what your bills are, and what's reported in the credit report. That's important because we've got to know if you've got the ability to pay that, and that's why I call it ability again with capacity. The last C is collateral, and collateral is important because collateral is used to secure credit, okay? And what I mean by that is so secured credit, a couple of examples, I'll just name a few actually, is a home is the biggest probably secured debt that you'll ever have. An automobile, certainly everybody drives one to work and has to have it. And then another one would be a boat. Now, unsecured debt or unsecured non-collateralized loan would be something like a credit card. As I mentioned with the collateral, if you don't pay your bills, what do? I can take that back. For a home, it's called a foreclosure. For an auto, it's called a repossession. But I have that collateral, and there's some value in that collateral. So even if I take it, it may not pay back the whole loan, but I've got enough money to offset some of that debt. So that's a lower risk loan, and that comes with a lower rate, okay? And but the unsecured rate, when was the last time that you saw a financial institution come into somebody's wallet and rip out a credit card? They didn't. They just closed the account. But the problem is the debt remains, okay? And you still have to repay that debt, but it's unsecured, but there's no tangible collateral behind it for the lender to base any tangible asset on it. So again, at the end of the day, that's a higher risk loan, and that's why you're going to in general see higher rates. Good example of that, you see auto loans at 0% or maybe 1.99 very, very often. Credit cards in general are, at the credit union, we're around 8%, but a lot of banks charge 18 to 21% for credit cards. That's the reason why, because there's no collateral behind it. So establishing credit in your name. These are some ideas for how to get started, and the reason, again, this is timely because, again, as we get to speak to you folks here at UWF, we get to talk about really what we're, creating a lasting relationship. It's just like creating a relationship with your significant other. If you don't mistreat your significant other, don't mistreat your lender, and that's the thought process. So I like to use the word relationship at the end of the day, because that's an important thing. So you've got to remember that, again, if it's good credit, you're going to have that forever, and you're going to have that much more buying power and ability to do the things that you want to do. One of the things that I suggest, especially if you're getting started in your credit file, or even if you're trying to rebuild a poor credit file, is to apply for secured credit cards. So we just talked about secured. You can do that with credit cards too. What you do is you secure it with savings, okay? And we hold that amount. So if you had a $1,000 secured credit card, we would hold $1,000 in savings. If you chose to use 200, of that credit line, that would reduce it down to 800 that we held in security. So it's always secured by the equal amount that's out there, okay? One of the other things that you can do is obtain a small personal loan. Now, generally those are unsecured as well. We call them lines of credit. At Penn Air, I think we've got different names for all of these programs, but it's a small line of credit that you can use for anything. If you're getting married, next spring, and you need $1,000, and you don't have that $1,000, you apply for the loan. Again, we're going to look for your ability to repay that debt, but that's a good way to start. $1,000 loan, fairly small, very controllable from your perspective. That's a great thing to do. What not to do? I'll give you a little bit of a story. Lindsay's heard this because I mentioned it at a similar seminar at Pensacola State College a couple of weeks ago. My son went to Purdue, and that was about 12 years ago, and he graduated 8 years ago, luckily, because in his first year, he went and actually went through the student registration and everything, and at the time, there were a ton of banks out there. I'm happy to say there were no credit unions out there, but there were a ton of banks, and every one of them offered him a credit card. And guess what he did? He took a credit card from every one of them. Okay? And how much debt did he get in? Anybody want to guess? $40,000 worth of credit card debt in 6 months. Okay? And so, I can blame it on his mother because he was living with his mother at the time. But the thing is he did have $40,000 worth of debt. Now, what did we make him do? We made him quit college, get a job that paid $18 at least an hour, and repay every bit of that before he went back to school. But that's the kind of thing that can happen, and so that's a way not to start a credit fund, because it's like going to Las Vegas and getting out of control and going, oh, you know what? I got, $1,000 and I want to spend it all and do that, and now I've got a gambling problem on top of that. Well, credit can do the same thing. You get all these credit cards and you have unlimited credit, and by the way, people go to Las Vegas and use their credit card to get cash advances, and that's the type of thing that can happen. And so start small. That's the big thing, is that small personal loan, using this stuff responsibly is what it is. My son's doing very well, by the way. So he got a master's degree in economics, so he did fine. But he learned his lesson. So the next thing is pay revolving debt in full each month, or at least to the 30% mark. And so, the best thing you can do for your credit score, now, your lenders don't necessarily like that all the time because they want to get that interchange and they want your interest and all of that stuff. But from a pure credit score standpoint, you want to at least be, if you can't pay it in full, which is a lot of people, at least pay it down to the 30% mark. So if you have a $1,000 line of credit, you want it to be at 300 or less on a monthly basis, and that's that 30% mark. And again, that's important. This is a difference between having a credit score. It actually can make a difference of about 20 or 30 points on your credit score, believe it or not. Which, in various, to various lenders, that can make a big difference on what you're being charged. Yes, sir.
Isn't it a good thing if you have a card that has a $1,000 limit on it, and paying it over time, then you decide, hey, I got to plan and pay this thing down to zero? Why is it good to not close that?
Yeah, in fact, I'm gonna get to that, and that's a good question. I've got that, and that's the purpose of debt utilization. And actually, I'm going to show you that on the next one of the next slides. Eliminating student loans. I know this sounds kind of ironic because I'm speaking to students here, but unfortunately, student loans are misreported often, and they're actually showed as not in repayment on the credit bureau, sometimes incorrectly, and when they're actually in repayment, and the student doesn't even know that. And so it's something, how many people have heard of the Consumer Finance Protection Bureau, CFPB? Okay, it's a recent government agency now. It was created to actually protect the consumers against lenders that are basically making bad choices and bad decisions for you. Okay, well, just as an example, and I think there's going to be legislation on this in the future where there's going to be rule differences on this, because one of the things that the CFPB just mandated is that medical collections could not be counted by the credit bureaus or the credit reporting agencies against your credit score, and it's because they're misreported all the time. You may pay your medical bill, they've misreported and said you haven't, and also insurance companies are constantly going back and forth with fighting those, you know, the lender and the hospital and your doctor and that type of thing. And so what did CFPB? They stepped in and they said, you know what, we're going to protect the consumer against those inaccurate reporting. I think that's going to happen with student loans, and then I can take that off of here, because you're likely going to have student loans when you come out. I know I did. So building a good credit history. Best thing to do is pay all your bills all the time, but also limit the number of open lines of credit that you have. You don't want to go willy-nilly. You do not want to do what my son did and open 10 credit cards at one time. That's just not a good decision. But you also, to the gentleman's point, you want to keep credit cards open definitely over a year. And my suggestion to you is to keep them open forever if you can, because what you've been given is a line of credit, okay? And that line of credit, they won't take it away unless you misuse it, okay? So what you'll do over time is you'll keep that line of credit. Think of that as purchasing power or buying power for the future. It's a picture of, again, your ability to repay debt. And the fact that you've paid it down, you know, to your point, you paid it down but didn't close the account, that's a great thing to do. Now, and this is a funny story, and actually one of the gals at PSC told me that her mother did this. You've heard of people freezing their credit cards? Well, sometimes they do that literally. They actually put it in a block of ice and put it in a freezer. And not a bad idea. It protects you from using it. I don't think you can swipe an ice cube or a huge ice cube in there. So some people do that type of thing too. But that's kind of the answer to that question. You want to create a mix of credit. So you want that installment. You want that auto loan. Over time, you want that mortgage. You want those credit cards. To have that mix of credit and to handle those types of credit, that's the way that you create, again, to the lender, an ability to handle collateralized loans, non-collateralized loans. They like it when you pay unsecured because you don't have to. In reality, there's no collateral there. So that's the thing, is create that mix of credit. Don't charge up to the maximum limit. That's the worst thing. So again, this gentleman's point, that one of the worst things that you can do is charge up to the maximum level, not only because you can't use it anymore because you're already topped out, but also because the lender looks at it as you've topped out all the debt that you have available. And so you don't have any buying power. And also the point is that you may be paying your bills right now, but you may not have the ability to do it in the future because you've got everything to the top. So don't charge up to the maximum limit. It's not a good idea. So what affects your score? Hopefully this is not big on my screen, but so 35% is history in how you pay your bills. So again, that goes back to that ability thing that I talked about, and even that willingness, but it's that history of how you pay. Now, ironically, that used to be 50% or even higher. It was all about how you paid your bill. Now, coming around the corner and making a big difference is that capacity thing, that 30%. And that again goes to that debt utilization thing. It's your lines of credit versus what you've got available. Okay? And if you don't have anything available, your lender is saying you're distressed. Okay? You're in distress. You're at the top of your limit. So that's, again, we call capacity in this case. It's also known as debt utilization. So it's a huge thing, and so that's another reason why you want to watch that. The length of time in your bureau is 15%. So how long did you keep it open? How long did you keep that file going? If you had an auto loan, did you pay it for 3 months or did you pay it for 48 months? believe it or not, it's better to pay it for 48 months because it created, you know, that report card of how you're going to pay your automobile over 48 months. If you paid it in 3 months, good for you. And I wish I had the ability to do that too. Actually, you do it in cash if you needed to in that case. But on the other hand, you didn't do anything to help your credit score because it was a short time. Accumulation of debt is 10%. So that's, again, just an accumulation of all the debt that you have. The mix, as I mentioned on the prior screen, is 10% too. So again, you've got that mix of credit that's going to make a small difference, but it is going to make a difference for you. So improving your credit score. Always pay your bills on time. That's an unequivocal. You just have to do it. And you know, I've always told people, you know, I started out actually as a collector, and I was the guy that had to repossess cars in a suit and go out and talk to people about why they didn't pay for their car bill and everything, and then I had to collect on them. And that was not a fun job. But you know what? At the end of the day, I always say, and this is a piece of advice I'll give you, always talk to somebody that you know or a relative. Try to keep your bills current at all times. Even if you have to borrow, you know, the important thing is you're going to pay them back, right? But at the end of the day, you've got to keep those bills current. It's just going to make such a big difference as you go along. Correct reported mistakes. And I'm going to give you another slide here in a couple of seconds about how you can do that. But you can't, if there's mistakes on your bureau, and credit bureaus do make mistakes and lenders make mistakes, they can be corrected. They can either be corrected with the lender or with the credit bureaus themselves. As I mentioned before, you reduce those card balances to 30% or less, and you do that over time. Now, on the next bullet point, I've got pay off debt and don't move it around. Now, there's an exception to that. If you've got a low rate credit card offer, let's say 0% or 8%, or you know, something that's fairly low compared to those 18 to 21%, that's where you can do a transfer because you're going to be able to pay off that debt a lot quicker than if you had an 18 or 21% interest charge. Because so if you had a $200 payment, your payment on your credit card is generally 2 to 3% of what the balance is. So if you've got a $10,000 balance, 2% is $200 a month, 3% is $300 a month. Now, if you're paying 18 to 21% interest, you would think it would be just a fifth of that. It's not. You're actually paying about, on a monthly basis, because it's accumulated over time, you're actually paying about, on that $200 payment, about $150 in interest. Okay? So only 50 is going to principal. How long is it going to take to pay off that $10,000 balance at $50 a month? It's actually on your credit card statement. If you guys have credit cards, look on your credit card statement and it will actually tell you how long it will take your balance. And that was one of the Credit Card Act requirements that changed, about 5 years ago, was it, John? Something like that. Yeah, and the Credit Card Act actually required the lender to say how long it would take you to pay off that balance on average based on the credit, on the interest that you're being charged. So that's an exception. Those 0%, free balance transfer, that type of thing, that's an exception that I'll say you can move it around. But again, back to the gentleman's point, don't close that other account unless you have to, because again, so you transferred that balance, but you may have had a $10,000 credit line. You want to keep that $10,000 credit line, and you've got a new $10,000 credit line with the other lender as well. So again, buying power. Okay. So I already covered that. I'm keeping unused credit cards open. Don't open several new accounts at one time. It's the kiss of death. Inquiries. And it's the last thing on the credit report. It actually shows inquiries. So we get to see who you applied for credit with, when you applied with them, not why. You can assume what it is. Now, autos are a little bit different. Most lenders, like we do, we have a thing called an auto-enhanced credit bureau. So we know that if somebody's shopping for a car, they may be going to 10 different dealers. Well, guess what those 10 different dealers are going to do? They're going to pull 10 different credit reports on you, okay? Typically, that would have killed your credit score, because that's like, oh man, this person's applying for credit everywhere. And let's just assume he's getting that credit everywhere. what's going to happen? He can't afford it. He's going to be that bankruptcy victim. So, so that's the whole thing behind that. Limit it. I always say do it. One of my rules of thumb is don't apply for credit unless you have to. And generally what you want to do is not do more than one every 6 months. It's not a good idea. That doesn't mean, if you had 3 different kinds of loans to get at one time, they're probably just going to pull one bureau on you and take a look at you that way. But again, just a little warning there. You don't want to shop, you don't want to apply for every credit or credit card that's out there, hoping that you get one of them. It'll kill you. And then stay out of bankruptcy. Again, that was that 7 to 10 year rule. That's a long time. I know the average age is 70 years now, but it's either a 7th or a 10th of your life, and that's a long time. So just make sure on that. So I covered this now. If you want a free credit report, you're actually entitled to one. There's actually reasons why you can get that. If you're denied credit within 60 days, you actually can get a free credit report. There's states that are on there: Colorado, Georgia, Maine, Maryland, Massachusetts, New Jersey, and Vermont, none of which we live in. But you can get that. If you're unemployed or job hunting, you can get a free credit report. If you're a welfare recipient or a victim of identity theft, you can get a credit report. One of the things that I'd like to mention too is you can also get a free credit report if you sign up for one of these identity theft monitoring things. Now, I was a victim of identity theft about 6-7 years ago. A gentleman actually in Florida, and he still moved to Florida, I don't know why after that, but a gentleman in Florida actually opened 16 different accounts in my name. He had a form of my last name, and he had the last 4 of my social security number, and that's all it took. And so we opened, I think he bought $20,000 worth of Dell computer, did a lot of damage. It took me about 300 hours to clean that up. Okay, and my credit score went from 820 at the time to 610. I was a little bit mad. So, but what did I do? I got an identity theft monitoring thing. It's generally about $8.95 a month. It's a great thing, but they also give you a quarterly credit report. So, and the difference is too, is every time you apply for credit, if you weren't the one that applied for the credit, you actually get a letter and a phone call generally to tell you, so did you apply for credit? Because it's a requirement that they call you and say, was it actually you that applied for the credit? To me, it's well worth, I didn't have that before, it's worth my peace of mind, and I would obviously suggest that for you. So that's the free credit report. Now, at Penair, as Stu covered, we're different from banks in a lot of ways, but one of the things that we do is we offer services, we do have lower rates generally, we pay higher dividends generally than a bank does, yes, but we also reinvest the net income that we get every year in programs that help our members. Okay, and one of the things that we do is it's called the Balanced Financial Fitness Program. So if you're a member of Penair, this is a free service. They actually do budgeting. You don't have to be in financial distress. You don't have to be having problems with your credit. If you want to talk to them about debt management, about housing counseling, that type of thing, it's actually run by the San Francisco Credit Counseling Bureau. And so it's a great program, and again, it's free of charge. It's my one plug for Penair Financial. Penair Federal Credit Union is this balance program is like another good example of what we do for them. Okay, and so there's lots of things that they do. Credit reporting area, as I mentioned, financial institutions are fallible. Credit reporting agencies are also fallible. They make mistakes. Okay, and sometimes you're going to have a misreporting on your credit bureau. And if you've got that monitoring kit that I was telling you about, that's another great way to say, wait a second, I haven't been over 60, with HSBC on my auto loan. I didn't have a problem with that. What do? You can actually write one of the credit reporting agencies, so there's 3 of them, Equifax, TransUnion, and Experian. You just write one of them. They all have to report the same thing. So they actually share reporting, okay? So you don't have to go to 3 different credit bureaus to actually get something fixed. Now, the Credit Bureau Reporting Agency also has 30 days to investigate that problem and get back to you. If they don't get back to you within that 30 days, they actually have to take it off your credit report as well. So I always tell people, if your credit report's not correct, honestly not correct, then you know, you do that, and it's an option, and actually quite a few people use that. So I thought I'd give you a little bit of a, you know, John did the budgeting thing last time, so how much can you afford, you know, in general? With mortgage, the total cost should not be more than 2.5 times your annual income, or 28 to 33% of your monthly income. And again, that's gross income. So think of it this way: if you, and I'll use $40,000 gross monthly income or gross annual income. That how many of us would like to have $40,000 gross monthly income? That'd be great. So 40,000 annual income, and so with 2.5, what that means is that you could afford a $100,000 home. Okay, and that's again in general. On an automobile, keeping that same $40,000 annual income, the total cost of the vehicle that you're purchasing should not be more than 75%. So in other words, that automobile that you're purchasing should not be more than $30,000. Now, lenders will look at these ratios, by the way, too. That's important for you to know, is they'll look at these types of ratios. So the unsecured, those were both those collateralized loans or secured loans. On the unsecured balances, combined, you shouldn't have any more than 30% of your annual income. So again, if you make that $40,000 annual income, you shouldn't have more than $12,000 credit card debt in your unsecured debt. Okay, and so those are again just rules of thumb. If you keep within those areas, again, that's what's going to, number one, get you the loan, but also from a credit score perspective and how you're handling your credit is going to be the best thing for you. So recap, again, start with a great relationship, always pay those bills on time, always maintain balances if you can at 30% or less. If you slip, don't worry. The great thing about your credit report is it's actually reported monthly, and your score can change on a monthly basis. It's how you handle it, and so it's how you handle it over time too. So don't worry about if I didn't get it down to 30% in that 1 month. It's not going to be the kiss of death. It's just 1 month. Okay, so just keep that in mind. Establish a long trade line history with a few credit cards, and I mean, you're going to have auto loans over time, and so but establish that long trade line history. And again, remember that good credit always stays on them. Okay, and then the last thing is obviously pay off those student loans as quickly as possible. Just again because of misreporting. And that's it. So I'm open for questions.